Hi and welcome. Today we will take a look at one of the tax types, one of the major tax types, value-added tax, to understand the background behind it, how it's enforced, how it's computed, the exemptions, tax rates, and all we need to know about value-added tax. First, it's important we note that value-added tax is one of the indirect tax types, and as such, the burden of tax is on the final consumer. It's otherwise known as a sales tax. In some countries, it's referred to as sales tax. Sales tax. So it's an indirect tax that is levied on the sales value of goods and services, except for goods and services that are exempted by the VAT Act of 2004 and 2019 as amended. So this tax type was introduced in Nigeria in 1994 as a means of increasing government revenue. The efficient collection of this tax led to some government fiscal policies, such as the scrapping of some forms of excise duties, the reduction of the marginal rate of personal income tax to 25%, the reduction of company income tax rate to 30%, the reduction of capital gain tax from 20% to 10%. The implication is that this tax type became a very productive revenue generating means for Nigeria or the Nigerian government. The reason for this is not far-fetched. As a consumption tax, most of the things we buy is subjected to value-added tax. As little as 5% could be cumulatively from the various transactions that you and I engage in on a daily basis. It becomes a reasonable sum. It comes to a reasonable amount. The authority to administer value-added tax rests with the Federal Inland Revenue Service. And the VAT Act provides for the establishment of a technical committee known as the Value-Added Tax Technical Committee, and is made up of a chairman who also doubles as the chairman of the FIRS, or the directors of FIRS, a director in the Nigerian Customs Service, and 3 representatives of state governments who shall be members of the Joint Task Force. So this technical committee takes decisions and manages all tax matters with respect to VAT, the administration, and all matters that requires technical expertise, and also make recommendation to the board. The revenue generated from VAT is distributed across the 3 tiers of government. This distribution formula or allocation formula has been subject to change over time. As you can see, in 1994, the federal government took 20%, while the state government and the Federal Capital Territory shared 80%. In 97, it was changed to include the local government. In 98, it was also changed to give out more to the state government and the local government. And an improvement was also made in 1999. Now, one will ask, who is a vatable person? The VAT Act defines a vatable person to be a person who trades in vatable goods and services for a consideration. A vatable person trades in vatable goods and services for a consideration. So therefore, every vatable person has an obligation to register for VAT with the FIRS. This registration makes the person a collecting agent for the federal government. Since it is a tax, is a sales tax, the individual who trades in vatable goods and services becomes a collecting agent, such that collects VAT and remits same to the federal government through the FIRS. So that way, the federal government can collect such taxes. At the introduction of VAT, the tax rate of 5% was placed on all goods and services, all vatable goods and services. However, the VAT Act also provides for some goods which are considered zero rated and some other goods which are considered VAT exempt. By zero rated, these goods are subject to VAT. However, the rate of VAT applied is 0. And as such, no tax is paid eventually, as anything multiplied by 0 gives us 0. Some other goods category are considered exempted items. They are exempted from VAT for the nature of the goods. Some of them are considered essential to livelihood, and as such, imposing VAT on them would result in an increase in their prices and could affect consumption of those goods. And particularly because they are considered essential to life, the acts or the legislators in their wisdom exempted them from being subject to VAT. Some of these goods include medical and pharmaceutical products, basic food items, books and educational materials, newspapers and magazines, baby products, commercial vehicles and spare parts, agricultural equipment and products, fertilizer, and veterinary medicine. These are exempted from VAT. So entities, individuals who deal on these goods do not have an obligation to remit or do not have an obligation to charge VAT nor remit same. Also, some services are exempted from VAT. We have medical services, services by community banks, people's banks, mortgage institutions, plays and performances conducted by educational institutions as part of learning, and supply of educational goods and services incidental to education by an educational institution. So these goods and services are exempt from VAT. Now, in the course of rendering VAT returns, an organization is expected to keep records with respect to its sales and purchases. For its sales, from its sales, the organization is expected to compute the output VAT. Output VAT is the VAT amount collected by a vatable person on his sales of vatable goods and services. From its purchases, the organization is also expected to compute input VAT, which is the VAT amount paid by the same vatable person on his purchases of vatable goods and services. So, for instance, if I am in the business of baking bread, and I buy flour, and I get charged VAT on the flour, that is input VAT on the purchases of vatable goods and services. If I sell the bread and charge VAT on the bread, that is output VAT. It is expected that in remitting VAT to the FIRS, entities should pay the net or to claim a refund, whatever be the case. The net, paying the net, meaning output VAT less input. If it gives us a positive amount, the organization pays that balance. If it is a negative amount, the organization claims a refund from the Federal Inland Revenue Service. So that is the basics for value-added tax, and it's expected that the payment period for value-added tax is within 21 days after the preceding month. So if you're paying VAT for January, you are expected to remit such VAT latest 21st of February, after which penalties and interest begin to accrue.